This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we're going to take a look now at a revision of some consolidation numbers. We'll be looking at example 2 and example 3 in your notes. So you will probably want to keep pausing the recording, because when I get to each part of the question, then it would be a good idea for you just to try the numbers first and then just check with the debrief. So make sure first that you've spent a bit of time reading the first example called Ray Example 2. Pause the recording if you need to, and then we'll start to talk through the requirements. So we've got to produce a number of workings. The first one is goodwill. Clearly, before we actually get too far into it, you'd need to do a group structure. But please, in the exam, don't spend half an hour trying to work out how to draw a group structure with a diagonal line or something. So you can just make a note, can't you, saying what your understanding is. When you saw this group structure, I can see there is a parent which owns 70% of a subsidiary, and the parent also owns 25% of the associate. So there's no need to draw a formal group structure or anything like that, but I'll do it in the way that you're probably used to seeing it. So example 2, there we are, parent, subsidiary and associate, and the two percentages that we just said were 70% and 25%. When you're asked for specific requirements like goodwill and so on, particularly if you're used to net asset workings, don't start madly writing up all those workings because you might not even need them. So pro forma what you need and then see if you can find the numbers, and if necessary, you'll have to do a working. But we know that goodwill, if you go back to the pro forma that we saw earlier in the course notes, is where you compare on one side, we need the cost or consideration plus the NCI less the net assets. The net assets must be measured at fair value. So they're the numbers that we're looking for as we start to hoover our way around the question. So what was the cost? I'm just highlighting that number in yellow. It's given. The cash consideration, again, that I am paying there is $13.40. So the cost is $13.40. The next issue is to work out how the NCI is to be measured. It says the NCI is to be measured not using fair values, but using proportionate goodwill. So we're going to need to have a look at that. Sorry, the screen just went strange for a second. So we need to do proportionate goodwill. Until we know the net assets, we can't work that out. But we are told that the net assets of the company that we acquired have a fair value of $18.50. The figure that you're looking for is the fair value. So the net assets, $18.50. When you do proportionate goodwill, remember what you have to do is you have to give the NCI their share of the net assets. 30% of $18.50 I think 30% of 1850 would be 555. So the goodwill drops out at 45. So I've dealt with the first part of the question, calculate goodwill. Keep pausing the recording so you can have a go at the next part before I talk through. Now we're going to look at the associate. The important thing is get your pro forma down first. So this bit you will have learned. You know that with an associate, I will always bring in the cost and the share of post-acquisition profits. I'm going to abbreviate profits using a little pi sign, if that's okay. Once I've done that, I can go back to the question and try and find the numbers. The cost of the associate is given here, isn't it? It's 200. That's easy to spot. Share of post-ac profits looks like a bit of a problem. The only thing I know are the profits for the year. Now the year ended is the 31st of December 15. We bought this company halfway through the year. So the year ran from January to December. I bought this company on the 1st of July. So you know there are 6 months before, 6 months after. So post-acquisition profits will just be for the last 6 months. So what have we got for the associate? We just said that the cost was 200. The cost was 200. The share, look back at your group structure, was 25%. We've only owned it for 6 months. 6/12 of the profit for the year 80. 25% of 6/12 of 80 would give you 10. So the carrying value of the associate is 210. The key thing every time is write down the formula and then try and see what you know and don't know. We're asked for 2 more things. The next one is the NCI. NCI will be the NCI at acquisition. Don't forget that's the same number as in the goodwill, plus the NCI share of the subs post-acquisition profits. There's no reference to any impairment, but that's what we're trying to get towards, isn't it? You can see the net assets acquisition, the NCI acquisition, back here in the goodwill working. It was 555. I know the percentage because I own 70%. The NCI have a right to 30%. And then you hit a bit of a brick wall because post-acquisition profits looks very complicated because there's been a fair value adjustment. So let's leave it for now and we'll sort that out a bit later. So where you see a figure that's troublesome, leave it till the end. Don't make trouble. The other thing we're asked for is retained earnings. So, retained earnings, pro forma first, which you'll have learnt. The retained earnings are the cumulative retained earnings of the parent. Then for the sub, my share of their post-acquisition profits. Then for the associate, my share of the post-acquisition profits. Start with what we know. Do we know the parent's cumulative retained earnings? We do. We can see them in the parent's balance sheet. So the parent has got cumulative retained earnings of 1450. Straightforward. Subsidiary, well, I know I've got 70%, but we've got the same problem as within NCI. Working out the post-tax profit of the subsidiary is going to be a mess. Leave it for a minute. The associate number will always be the same number as we've used in the associate working. Because in the associate, you bring in share of post-tax profits. In retained earnings, you also bring in share of post-tax profits. So you don't need to work it out again. I'm just saying, see my associate working. It'll be the same number. So this number here will be the same as the one we used in the associate, which was 10. So what we're left with are the subs post-tax profits. Now, I've tried to put quite an advanced working in the answer and see if you can have a look at it after, because that might be a very quick way to work it out. But if you find that conceptually too hard to follow, then you could use something like a net asset working to try and get to the bottom of the subs post-tax profits. People do these in different ways, but in a net asset working, you need to summarise. This is for the subsidiary. If you're saying, well, you'd like to do one for the associate, I'm saying, why? No one asked you to. You need to find out the net assets of the sub at acquisition, the net assets at the soft P date, and the change. Many of you will be used to using this. Down the side, you list the reserves. So share capital, retained earnings, misalign, or so, and that will give you the total figure. And then you have to be like a detective trying to find these numbers. Remember, we're looking at the subsidiary, so don't look at the wrong company. So the share capital of the subsidiary, back on the question, was 1,000. That never changes. Let me just change highlighting colour for this bit. There we are. The share capital is 1,000. That will never change. What else do we know? We know the retained earnings. At acquisition, the retained earnings were 450. At acquisition, they were 450. Today, they're 800. They were 450, and now they're 800. The other piece of evidence that we've got is we know the total fair value of the net assets. The total fair value of the net assets, we've already used this number, was 1850. Now that in fair value terms, the other amounts are in terms of the original carrying amount. The balancing figure will be the fair value adjustment, which relates to some kind of non-current asset. So it's a balancing figure. So it looks at acquisition as if it was 400. Now that relates, let's have a look back to the question. It relates to an item of PPE with a life of 10 years. So I bought this company 2 years ago. It's now the 31st of December 15. So that asset will have depreciated away. Its life was 10 years. At the balance sheet date, there are 8 years left. So the fair value, depreciated fair value in the balance sheet, now will not be 400. It'll be 8/10 of 400. 8/10 of 400 is 320. Finally, I've now got my grand total, 2120. Since acquisition, post-tax profits are 270. And in a minute, that's a number that's going back upstairs to our answer. So if you think you can work it out in a different way and you're getting to the same answer, it's absolutely fine. Again, at this level, you'll either have it right or wrong. This examiner does not give half marks. So, if you've got the approach right, you'll get a mark. And if you haven't, you won't get a mark. And, it's not worth 15 minutes worth of effort. So that was worked out in a working. So the 270, it would be good to indicate you got it from a working. So they think you haven't just made it up. I can now finish off the NCI. 30% of 270 is 81, which is 636 in total. 70% of 270 is 189. So I think that adds up to 1649. Again, you can see all those numbers in the printed answer when you want to have another go at that question. So that was a reminder about how we would actually calculate the key numbers in a consolidation. Of the ones that are there, the ones that will definitely be in your exam would be the first two, goodwill and associate, but they could ask for the others. We're going to have a look at another example now, which is example 3. If you've not come across this phrase here, other components of equity, or OCE, again, other components of equity is all of the other reserves. Share premium, revaluation reserve, whatever else they've got. So it's those sorts of things. So you may not see the word share premium, you'll just see other components of equity. So have a look now at example 3 and the requirement. Pause the recording and then we'll talk again. Maybe have a go at the first part. Listen to the recording and then the same with the second part. So the first part of the question asks us to work out goodwill using the two different methods, proportionate and fair value. That's very useful for us because you need to be aware how to do both. I know you are aware from what you've studied in the past, but it's important. So we need to sort out the goodwill As always, the key thing is to get down your pro forma. This is a very straightforward group. Again, it's an 80% subsidiary. So, example 3. So I said before, there's no need to try and draw a group structure down the page and get into a mess. But I'm just making a note here. It's an 80% subsidiary, so I don't forget. I'm going to work out the goodwill. So when you're using the Excel software, you could do it in columns. You don't have to. If you find it easier just to work them out twice, that's all right. Proportionate and full goodwill. Whichever method of goodwill you're using, the pro forma is the same. Cost plus NCI less net assets. Pro forma first, and then we attempt to fill the pro forma in. So let's go back to the scenario and see if we can find the cost. There it is. I'll highlight these numbers in yellow. The cash consideration is 5,400. So that will be the same in both columns. Let's find the net assets. The net assets, see if we can find it, have got a fair value of 3,400. That will be the same in both columns. If we're using proportionate goodwill, NCI, as in the example 2, will be 20% of the net assets of the sub, 3,400. 20% of 3,400 is 680. Then we can cast, and I think the answer would then come out as 2,680. If you use full goodwill, the fair value of the NCI will be given in the question, or at least I'll indicate how to get there. There it is, just highlighting in yellow, the fair value of the NCI acquisition, 700. So the goodwill comes out slightly higher at 2,700. In theory, what does it mean? You can see there's a difference of 20. Well, the 20 is the amount of goodwill that relates to the NCI. It will be very low because they don't have voting control at the meeting. And every time they put their hand up and say, we want to do this, the parent that's really in charge will say, well, we're not going to do it. So it doesn't have that much value. But unless something's gone seriously wrong in your calculation, I think the full goodwill ought to be bigger than the proportionate. So you could be asked for both or either. The full goodwill is easy. It's a difficult one in practice because if the subsidiary is not listed, where has this 700 come from? Well, they've perhaps wandered down the road, approached a gypsy or a fortune teller and asked for the number, 700, I think that's the value. So people get very annoyed about that. People includes me. What's the other requirement? The other requirement is to do other components of equity. So be careful. Don't start doing net assets left, right and centre. You will not be asked for all the workings. But they want OCE, other components of equity. Remember, other components of equity is a bit like a phrase, other reserves. The pro forma will be exactly the same as the pro forma for retained earnings. It's the parent's cumulative other reserves, all of them, plus the share of the subs post-acquisition other components of equity. Well, we'll go back to the scenario and we'll find the parent's OCE. There it is. It's like a jigsaw, isn't it? Well, a bit. Other components of equity, parent 1,000. Group structure, subsidiary, it's an 80% subsidiary. Again, don't dash off and do a net asset working. You might not need it. In fact, you don't. If I just change colour highlighter, there we go. The other components of equity now are 625. The other components of equity were 400 at acquisition. That's all you need. 80% of 625 minus 400. 80% of 225 would be 180. So that would give me, therefore, group other reserves or other components of equity of 1180. Do redo those examples, occasionally. Although they're quite straightforward, they've not introduced other knowledge. They're good just to recap the basics and get you into rote learning the pro formas for the workings.